Again with the derivatives and related accounting issues. In this video, we will discuss learning objective number 5 and 6. First of all, we will discuss the basic objective of an interest rate swap. What's interest rate swap? Then we will move to discuss how a derivatives instrument may be used to reduce or avoid the exposure to risk associated with other transaction. Let us start with interest rate swap. What's interest rate swap? Interest rate swap, we can say it's a type of forward contract. As we discussed in previous videos, forward contract is a negotiated contract. We use it to protect us against the fluctuation of commodity prices or foreign currency prices. This is in general what's forward contract. But here we are talking about interest rate swap. Interest rate swap again is a type of forward contract. It means it's negotiated contract, it traded on or not traded on regulated exchange. This is the opposite of future contract. Future contract is not negotiated, it's standardized contract and traded on regulated exchange. But as a swap is a type of forward contract, so it's not traded on regulated and it's customized, not standardized. So it's negotiated contract. The point is, what's the benefit of a swap interest rate? We aim, when we enter into swap interest rate, we aim to protect ourselves against the variability of interest rate or against the fluctuation of interest rate. Here, the question is, mostly the interest rate is determined according to labor. Labor is the London interest bank offered rate. So usually the labor is determined, we can say day by day. So we are talking about variability in or variable interest rate. Mostly we can say the labor is 200% plus the interest rate or the required rate by the bank is 200%. So in total we are talking about variable interest rate around 400%. This is the offered interest rate when we for example borrow from the bank a certain amount. So the point is, we aim to protect ourselves against the fluctuation of labor. So how can we protect ourselves? We can enter into a swap interest rate. Let us see what's the mechanism of a swap interest rate by the following example. Here we, as a company, we have borrowed amount from this creditor by $10 million. Now the variable interest rate is 6.700%. So we fear from the increasing of interest rate as we borrower. So may the interest rate, because we borrowed according to variable interest rate, it's not fixed interest rate. So we fear of what? Increasing the interest rate. So what can we do? We can enter into a swap interest rate. What's the mechanism of a swap interest rate? Here we will go to the bank as a counterparty. We will borrow and lend the bank. This is the point. We will borrow, we will lend him, and we will borrow from him. We will lend him the amount that we borrowed by 6.7 as interest rate, and we will borrow from the bank by fixed interest rate. This is the point. Here there is an important point. We are talking about two parties. One of them will expose to potential loss. One is exposed to potential gain. We are not talking about win-win. One of them will expose to potential loss. one of them will exposed to potential gain. Here, as borrower from this creditor, and we fear from increasing the interest rate, we enter into swap interest rate by this bank as a counterparty. We will borrow him the amount that we borrowed from this one by variable interest rate, and we will borrow from him the same amount by fixed interest rate that we are agreed to be 6.5. So what will happen? Look at this. Look at the following numbers here. As we borrowed, we will pay to this one, the creditors, 10 million multiplied by the variable interest rates that we are agreed to pay, 6.7 for 6 months. So the variable interest paid to creditors, $335,000. On the other hand, as we entered into interest rate swap, we will receive variable interest received from the banks the same amount as we lend him the same amount by the same variable interest rate. So we will receive from them the same amount of interest, 335. But on the other hand, we will pay fixed interest amount to the bank that we borrowed from him the same amount by fixed interest rate. So we will pay the bank 6.5 as interest rate, annual interest rate, annual fixed interest rate by $10 million, the amount that we borrowed by 6 months. So we will pay them 325. So the point here, we have paid fixed amount as we entered into a swap interest rate. So the point, net interest paid here equal the amount we paid to creditor, the amount we paid to the bank, minus the amount variable we received from the bank. So the net is this one, offset this one. So we will pay this amount as fixed interest amount. Here we will pay as fixed interest amount $325. The point here, we are to, as the interest is increased, so we exposed to potential gain in this case. On the other hand, the bank exposed to loss because the interest has increased and we pay the interest that we have paid is 6.5 less than the variable interest rate on the date of occurrence. This is for first point of this video, swap interest rate. Let us move to next point, how a derivative instrument may be used to reduce or avoid to exposure to risk associated with other transactions. As we discussed before, may we entered into forward contract or a future contract. Here, the future contract, as we discussed before, we determine the price that we are agreed to pay in the future. For example, suppose we entered into future contract to buy corn by, for example, $2,000 per ton. Suppose that. Here the point, already we have entered to this a future contract or forward contract, and this contract will be executed after 3 months. Okay? Only here we are talking about, or the point we have discussed in the previous videos, we entered into future contract only to execute the future contract. But here in this section, we are talking about entering into future or forward contract to protect ourselves against existed transaction. This is the point. Let us clarify it by the following points. Here we have, for example, a transaction to sell, for example, 100 tons of corns after 3 months. Already we agreed to sell this goods by, for example, 1,500 per ton. The point is, may we fear of changing the price? We will sell it after 3 months as a commitment, or already we sell it but we will or receive the cash but we will deliver it after 3 months. So to protect ourselves against the fluctuation as we sell or as we sold, so we fear of increasing the price on the date of delivery. To protect ourselves against the increasing the prices, may we enter to a forward contract or future contract to buy quantities on the delivering day. This is the point. Already we have sold, but we will deliver it after 3 months. So against the changing of a price or against of increasing the price, may we enter into forward contract or a future contract to buy the same amount of a quantity on similar delivering date. This is the point. Or suppose we entered into agreement to buy corn after 2 months. So against we fear of decreasing the price as we bought. So may, on the other hand, to protect ourselves against dropping the prices, may we enter into forward contract or future contract to sell the same amount of these goods, whereas we fear of dropping the prices. Here in the next videos we will discuss by numerical example what's the accounting treatment. But before that, let us talk about the hedge about the fair value or cash flow hedging. What's fair value hedge and cash flow hedge? We use fair value hedge to offset a change in the fair value of item with fixed prices or rates. The point is, we hedge or we enter into fair value hedge against a change in the fair value of what? Recognized assets or liability. It means already we have the goods as assets. So goods as assets or as inventory. Against the fluctuation of assets we have, we enter into forward contract. In this case, we are talking about fair value hedge. So the point is, as we entered into fair value hedge, because already we have the recognized assets or liability, we will recognize the amount of earning, the amount of gain or loss in the income statement as period income or period loss. On the other hand, when we enter into forward contract or a future contract or whatever the contract we entered in, to protect us against forecasted transaction. What does it mean, forecasted transaction? We don't protect ourselves against existed liability or assets, but we forecasted that we will receive a certain amount of foreign currency, or we will purchase a certain amount of corn or what commodity we are going to purchase in the future. So against the expected transaction, we entered into forward contract. In this case, we are talking about cash flow hedge. When we entered into cash flow hedge, in this case, the amount of gain will be treated as other comprehensive income, because we are not talking about occurred transaction. We are talking about expected or forecasted transaction. This is the main difference between cash flow hedge and fair value hedge. As we entered into fair value hedge, we will recognize the amount of gains as a period income. Otherwise, when we talking about cash flow hedge, it means we are talking about forecasted transaction or the variability in cash flow associated with recognized assets or liability. In this case, we will not recognize the amount of gain as period income, but we will recognize it as other comprehensive income. What's the accounting treatment of cash flow hedge and fair value hedge? That we will discuss in the coming video. Let us move to see it. See you there.